This is Ralph Sass, and this is a continuation of the lecture for Chapter 6 and Accounting to 11. Most of the time, and this applies to you both as a purchaser or a seller of merchandise, you offer credit terms or cash discounts. The reason why you do this is because you want to be paid as early as possible. There's a whole ream of evidence that says that the sooner a customer pays you, the more likely you will get paid. Some of the more common terms are 210 net 30, and that's the way you read this. And what that means is you get a 2% discount if you pay in 10 days. The net amount is due in 30. Now, I know most of you would not get out of bed for if they were offering sale prices with a 2% discount. That being said, that 2% discount works out to being about 30 some percent in a year. And so my point is that a 30% interest rate, 30% plus interest rate, which is what it works out to be, I think it's like 36.2 or something, is well worth it. So it really does pay if you've got the cash to take advantage of those discounts. And 210 net 30 is a really common one. What this does is this adds some complexity to how we're going to record purchases and sales. Okay, so I purchased 100 spreadsheet programs in this case for $100 each with terms of 210 net 30. Whenever I buy something, I am always going to assume that we are going to pay and take advantage of that 2% discount. The interest rate is very high if I don't. The cost is very high if I don't. And so I want to take advantage of it. So I am going to put the items into my accounting books as if I am going to take advantage of those. So in this particular case, I take the 100 spreadsheet programs at $100 each, which is 10 grand. I'm going to get a 2% discount, so I'm going to have to pay 98% of that. So what I'm going to do is put in my accounting records $9,800. And notice once again, accounts payable PC products. I'm going to end up posting that twice, once to the controlling account and once to the subsidiary account. And on November 10th, when I pay the full amount that I owe them, that becomes very easy. Just accounts payable PC products, posted twice, and cash, $9,800. Accounts payable, just a quick note, it's a liability account. To make that liability go down, I debit it. And credit is going down, cash is going down. To make cash, which is an asset, go down, I need to credit it. So makes perfect sense for all those items that we've taken a look at in the past. Now the question is what if I don't pay in the 10 days? What if for some reason the bill I lost it, I forgot, blah, 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 blah. Well, now I'm going to owe them the full 10 grand. So the cash that's going to go out the door is 10 grand. But notice my accounts payable in PC products was only 9,800, and my debits and credits need to be equal. So what I'm going to do is create another account here, a debit for $200 to an account we're going to call a purchase discount lost. And it's going to work out as an expense account. And the reason why I'm going to do this is because if I see that you're in charge of paying the bills and I have a lot of these purchase discounts lost, I'm going to call you into my office and say, why in the heck aren't you paying these bills on time? These $200, add up to be a significant amount of money, and you're costing us profitability, what have you. And you better be prepared to explain yourself. So I want to keep track of this a little bit separate, just from a management and a control standpoint, so I can make appropriate decisions. Okay. In this particular case, I will point out to record them at net cost is the most common way to do it. There are some companies that purchase it that record the purchases at gross invoice price. This is an exception, not the rule. In this particular case, okay, they purchased 10 grand. The terms are 210 net 30. They put it in their records at the entire 10 grand. And then if they take the discount, they have a separate credit account for purchase discounts taken of $200. Okay, And what that purchase discount's taken will do is reduce the cost of goods sold. Keep in mind, cost of goods sold is an expense account. Purchase discounts taken being a credit, we'll go ahead and reduce that. Now, the reason why this isn't used very often is it becomes very easy for the accounting folks to hide the fact that they're not taking purchase discounts, okay? Because there's nothing that'll show up if they don't take advantage. If they don't take advantage of that discount, it'll just show up as 10 grand. So because of that, most companies do it at net invoice price, not gross. Okay, and keep in mind when they pay the full amounts due on the 10th, in this case of December, it's just accounts payable cash. So it becomes really easy if they don't pay it within the 10 days. Okay. When someone returns a good, I have to know if I'm doing it at net cost or gross cost. If the purchase was originally purchased at net cost, as it was in this particular case, I have to credit them at net cost for their returns. So what I have to do is take that $500, multiply it times 0.98, okay, and my credit to them is only going to be $490, and my inventory, the amount coming out of inventory, is going to be $490. Why? Because I recorded it at a 0.98. Okay, I recorded the 2% discount. When I return those goods, I have to make sure that I've taken into account that 2% discount. Transportation costs, any cost to get it into my plant, into my factory, into my store, is going to be included as a cost of the asset being acquired. Okay, so what I'm going to do, I'm just going to leave it here. So those are transportation costs. Those get included in cost of the asset. So that's going to become part of cost of goods sold. So if I pay for the goods to come into my store, transportation in gets called cost of goods sold. If I pay to deliver, then it's going to be a sales expense and not be included in cost of goods sold, but be included as a sales expense under gross profit. And be included like salaries expense or utilities expense, what have you. The reason why we keep track of sales returns and allowances, we also keep track of sales returns and allowances separate. And the reason is because we want to know if we're getting a lot of merchandise back. So if we keep track of it separate, it'll give us the opportunity to notice if we're getting a lot of things back, which will allow us perhaps, maybe we want to buy a better quality supplier. Maybe we need to change our product description so people aren't confused and order the wrong stuff. So we do want to keep track of those sales returns and allowances and the sales discounts separately. We don't want to throw it all into sales because a lot of good quality information gets lost. When we sell an item, okay, keep in mind, I sold $2,000 worth of merchandise on terms of 210 net 30. When I am buying the goods, okay, I can record it at net or gross price. When I am selling the goods, however, I have to record it at gross price because I have no idea if my customer is going to take advantage of my credit terms. Okay, so when it comes time to sell goods, I always record it at the gross price. So in this case, I record, even though I've given them terms, I record the $2,000 at the gross price, realizing that if they pay within the 10 days, I'm going to have to adjust the dollar amounts to properly reflect that. Once again, notice a couple of items here. Accounts receivable Highlander Pub means that I'm going to have to post that twice. And notice that I have an inventory account and a cost of goods sold, so that means I'm using a perpetual inventory system. Okay, now notice in this particular case, they returned some goods. So my sales returns and allowances are $1,000. That sales returns and allowances is not an expense account, okay, even though it's a debit, it is a contra revenue account. And that's why it's going to show up on that balance sheet as sales minus sales returns and allowances. It's a contra revenue account. Basically what that means, remember, contra. It's a revenue account with a funny balance. So we usually have credit balances for revenue, so a contra revenue account would be a debit balance. And notice when somebody returns stuff, I also have to add it to inventory, assuming it's good and sellable again, whatever, at whatever the cost was. So notice when somebody returns something, I need 2 journal entries, one to back out the sale and the other one, the second one, to get it back into inventory. And notice what it does. It debits inventory, which pushes inventory up. It credits cost of goods sold, which is an income statement item. Cost of goods sold typically has a debit balance. This is crediting it. What does that do? It pushes cost of goods sold down. Now, when they take advantage of the sales discounts, notice what I'm going to do. They're only going to send me a check for 980 bucks. So my cash is only going to go up by 980, but I have to account and I have to credit them for the full amount of the $1,000. So I have to credit accounts receivable, the pub, for $1,000. I need my debits and credits to be equal. So what I need is that other $20 to be a sales discounts, okay? And that sales discounts is also going to be a contra revenue account, a revenue account with a funny balance, okay? I already mentioned this. Delivery costs, which are incurred by the sellers, are debited to delivery expense, which is an operating expense, so it does not get added to cost of goods sold. As we all know, almost all the items we sell do have a sales tax. Okay, businesses collect that for us. Notice what they have here, and this is, overly simplistic perhaps. Notice the sales in this case was $1,000. The cash they collected was $1,070. Why? Because there's a 7% sales tax. Notice where that 70 bucks goes. That 70 bucks goes to sales tax payable. And at the end of the month or at the middle of the month or whenever it's due for that particular company, they're going to write a check to state of Virginia, state of whatever, to pay those sales tax payables. So when you take a look at your receipt that you get from, Home Depot or wherever, and it says that there's sales tax at the bottom, that went into sales tax payable. And whenever it's appropriate for that particular company to pay that, they're going to submit that to whatever state they're located in. Okay. Lots of companies use special journals rather than a general journal to record routine transactions. Already made mention of this back in, I don't know, chapter 2 or chapter 3. It's not unheard of for there to be an accounts receivable clerk and an accounts payable clerk. And for example, accounts receivable, all they will handle is the cash coming in, okay? And all they will do is accounts receivable. And what we then know is because they're handling accounts receivable, okay, they're working on just the credit entries because the debit entries are all going to cash. Likewise, accounts payable clerks, what have you, are once again working in a special journal, but all those transactions, because it's accounts payable, all those transactions at the end of the day or the week or the month are all credits to cash. So all they have to do is write down the debit entry. Bottom line is that there are a lot of times where we do use special journals. And finally, a little bit more on financial analysis. Some things that companies look for. Let's start with the net sales. Sales per square foot of selling space. Really important for retailers. Best retailer out there is Apple, and they have an astronomical figure for their revenue per square foot of sales. But different stores, and you can see there they've got comparable store sales, okay, and they'll often compare, the store this year to the store last year, sales numbers to make sure, are sales going up in that particular store or down. So they do that. It also depends to a large extent on the industry you're in. The one I love is for hotels. It's RevPAR. It's revenue per available room. And so what they look for is RevPAR. What's the RevPAR of that particular hotel, what have you. Moving over to gross profit margins, that's the gross profit divided by net sales. Gross profit margins are frequently calculated by departments, by products, by stores. There's a whole bunch of different ways to calculate it. And gross profit margins are also a very important way to tell what's going on in a particular business. Okay. Once again, all I can say here is do what's right. If you have questions, ask. Lots of times people have found ways to fraudulently um, modify their accounting results using sales discounts, purchase discounts, transportation in, whole bunch of different things. I guess my only advice is when in doubt, ask questions, because there can be a lot of spots for fraud in those particular items. That concludes the lecture to Chapter 6. As always, if you have any questions, please let me know.